then. Eric Robertsen is with us now, Global Head of Research at Standard Chartered Bank. He joins us from Sydney. Eric, great to see you and good morning. You make the point, as did Steve Cochran from Moody's Analytics earlier on this morning, that the global debt load is reaching record highs. What then do we do with this information? Should we step back from the banks that are exposed and those markets that are exposed?
Well, no, Sri, I don't think it's as simple as making a statement about banks. I think what we're trying to highlight to people is that, one of the ramifications of the COVID crisis is that both corporations and governments have had to issue an enormous amount of debt to keep their economies and their business operations moving in the right direction. Now, in a world where interest rates are low, an increasing debt load is not necessarily problematic, but as we're starting to think about, with higher inflation expectations and steeper yield curves, there does come a point where that debt load becomes a headwind to growth, if you will. So it's just something we're thinking about, and it's something that we think people need to be paying more attention to.
No, absolutely. And I mean, my question to you, Eric, is the ratings agencies are not going to give a free pass to those sovereigns indefinitely, given the yawning deficits. At what point do we need to see those sovereigns take some remedial action? I'm talking about deficit busting measures and fiscal consolidation, whether it is taxation or otherwise.
Yeah, no, look, Sri, you make a great point, which is that the ratings agencies have certainly taken a more forgiving stance towards debt issuance, as I said earlier, as people are trying to get themselves back on a sustainable pace of growth. I think what we want to see over the next couple of years is, as growth improves, obviously debt to GDP ratios will come down, but what the ratings agencies will want to see is some plan for fiscal discipline, and that could mean higher taxes, it could mean reduced spending. But at some point, debt issuance will need to slow down. Otherwise, the ratings agencies are going to become a bit more concerned. Now, interestingly enough, even with all of this debt issuance that we've seen across both developed and emerging markets, foreign currencies have been quite a bit stronger against the dollar over the last 12 months or so. If you were to see countries really start to lag on their fiscal discipline, you'd probably start to see that showing up in currencies first.
Indeed. Eric, this is Martin. Great to see you again. Let me quickly jump in with a question here. We've already seen China start to dial back on the fiscal side. In terms of monetary policy, though, most of the conversation has been about the Fed and whether or not, say, Jackson Hole is going to be the time when they start the conversation or start warming to that conversation about taper. But our side of the world, Australia, and do you think New Zealand is going to be next to start raising this conversation about taper? I mean, they meet on the 26th.
Look, Marty, good question. We are seeing really spectacular growth in large parts of the Asia Pacific, Australia, New Zealand included. And I think what you're waiting to see is, as government support measures, whether it's job keepers allowance or other forms of subsidy and stimulus, are taken away, do the economies have the underlying strength to maintain their momentum? And I think in the second half of the year, we will see a number of the G10 central banks start to dial back on some of their asset purchases, whether it's Australia, New Zealand, the Bank of Canada, Bank of England, and as you mentioned, obviously the Fed coming up in the latter part of the year. So I think that's a really key trend to watch for global bond markets.
Eric, if that's the case, then which currency should we be watching for? You would expect appreciation, right? I mean, for example, New Zealand, again, RBNZ meets on the 26th. We've already seen the Kiwi starting to fly. How much more upside is there, do you think?
Well, look, we do think that there's more upside for the commodity currencies in the developed world. And the reason we say that is, in spite of the spectacular increase in commodity prices we've seen since, March and April of last year, a number of these currencies, while they have appreciated, have actually underperformed what you would expect based on that terms of trade improvement. So, look, gun to our heads, we prefer the Aussie dollar over the New Zealand dollar. We like the Canadian dollar as well. And I think that trend is going to continue. But as we've seen over the last few days with the pullback in commodity markets, it's not going to be a straight line either. It's going to be some noise and some volatility.
Eric, let me put you on the spot. And where do you stand in terms of this inflation narrative? Are you a transitory sort of chap, or do you think that this is going to be sticky and overshoot? And if I can also ask you, Jackson Hole in August, what are your expectations there?
Sure, Sri. We're in the transitory camp. We've been arguing for quite a while now that you would see a surge in inflation and core inflation in the middle of the year, both in the US and in most economies around the world. But we do expect that surge in inflation to revert back towards something closer to trend. So in the US, for example, we can see core PCE at 2.5%, 3% mid-year, but heading back towards 2% by the end of the year. So that should take quite a bit of pressure off of the Federal Reserve. In terms of the taper discussion in Jackson Hole, you are starting to hear a little bit more commentary out of the Fed about, to use their language, thinking about tapering. I think that noise will get louder as we approach Jackson Hole. I think Jackson Hole will be a very good platform for wider discussions, but we don't expect any tangible or concrete tapering announcements until at least the September FOMC meeting, if not later.
Eric, I know you think that gold is likely to get a lot more investor attention. How much of that has to do with thinking that maybe dollars topped out and we've seen peak $1, and that whole inverse correlation with gold to dollar is going to be back in play? How much of it is because, as many people think, we may have seen a blow off top in cryptos, and therefore that money is going to revert to gold?
Well, look, Marty, on the first question, there's obviously a very strong historical correlation between dollar and gold. What we have found over the last year or so is that actually gold is trading much more in line with real or inflation-adjusted U.S. interest rates. Real yields in the U.S. across the yield curve remain deeply negative. In our view, that is supportive of gold. But as you mentioned, this year we've seen a surge in sort of alternative safe haven assets, whether that's cryptocurrencies or other forms of digital assets. And look, as volatility creeps up into that space to ever higher levels, I think people are looking back at gold and saying, as a safe haven asset, it's extremely stable by comparison, and a relatively known quantity. So I think this rotation that we're seeing back into gold from some of the other commodity markets as well, in our opinion, makes gold extremely attractive for the second half of the year.
Okay, we'll be watching the yellow metal then. Eric, listen, we got to go. Great to talk to you. Appreciate spending time with us. Keep safe. We'll do it again very soon. Eric Robertson, Stanchart.